Hello and welcome. I see that people are still trying to connect, so we'll wait a few minutes here before we get started. Thank you for joining in today. We look forward to engaging discussion. I can see that people are continuing to join, so I'll give another few seconds here before we get started. My name is Twyla Albrecht, and I would like to welcome you to the final webinar in our 2019 series of nonprofit boards. This afternoon, we've invited Elisa Miller, Director of MHS Consulting, to lead us in a discussion with special guest Jim Longacre. As a reminder, we will have some brief time for questions at the end, so be sure and submit your questions using the Q&A button on your screen. So thank you, Elisa, and let's get started.
Great, thank you, Twyla. Hello, everyone, and thank you for joining us. As Twyla said, our topic today is effective CEO assessment and setting compensation. I'm delighted to introduce a co-speaker joining us, Jim Longacre. Jim is an attorney with Stevenson Lee. Stevenson Lee is a full-service law firm. Concentrates his practice in employee benefits, ERISA, and executive compensation matters. Jim is also on the board of directors of Frederick Living, a sponsored member of MHS. Jim. Our agenda for today, we'll start with the CEO appraisal assessments, and then Jim will discuss planning strategy and alternatives for CEO compensation, and we'll leave time for your questions. We typically receive questions about CEO appraisals or assessments from one or two sources. First, from CEOs concerned or maybe even frustrated that the board has not done an assessment. From board chairs who may not have a clear understanding of the process. One of the most important responsibilities for boards is to hire a CEO. This responsibility includes ongoing evaluation of the CEO and setting CEO compensation. We believe both the CEO and board benefit from an appraisal process, and it should be viewed as an opportunity for growth, both for the CEO and the organization as a whole. The quality of the board-CEO relationship is crucial for the well-being of the organization. As you can imagine, we generally do not find an organization be highly successful if the board-CEO relationship is dysfunctional. As you think about what we generally view as best practices in leading teams and team engagement, practices that include leaders providing timely feedback to their team, feedback that is ongoing, memorable, and with no surprises. These practices and principles also are true about the board-CEO relationship. We've collected some data from a board source study that provides statistics about how not-for-profit boards are doing as it relates to annual CEO assessments. Most, but not all boards, regularly evaluate the performance of the CEO. We found that about 72% of executives report they have received a performance review in the past 2 years, about 60% in the past year. However, about 15% of executives report they have never been formally evaluated by the board. For boards that are regularly conducting reviews, there is evidence the review process can be strengthened. Only about 59% of executives report their evaluation was based on mutually agreed upon goals. 16% of executives report they do not have any written goals. You could use these data points as a reference to evaluate where your organization is in regard to these practices. The board's work, as you know, relies heavily on a strong partnership between the board and CEO. Open communication about performance and taking time to align goals and expectations for the future. Using the annual CEO assessment is an effective tool to develop a strong partnership. A well-designed executive appraisal can contribute to a strong, healthy relationship between the CEO and board. In addition, a thoughtful appraisal will usually lead to more effective long-term organizational performance. Well-designed executive appraisal provides an opportunity to review the CEO's performance against expectations or goals, to clarify future expectations, to plan for growth, and to build trust in the relationship. We've identified a few best practices in regards to CEO appraisals and assessments. The first is to set and document goals. It is critical to establish goals and expectations for the CEO. One of the reasons we see organizations have unplanned transition is often from not establishing goals and expectations with the CEO. The goals and expectations need to be clear, measurable, and well documented. The next best practice is to schedule the appraisal on a regular basis. We recommend annual appraisals. It's also important to designate leadership. It's essential that the board clarify which board member or members, and some organizations identify a committee or task force to do this work, but it's important to designate that leadership for the appraisal process. Board leadership demonstrates board commitment to excellence and support of the CEO. It's also a task that should not be burdened on the CEO to coordinate this process. We recommend using professional resources, and by that I mean formal tools and establishing a formal process. Some organizations opt to use a third party, but that's not necessary, but it is important that it should be more than just a casual conversation between the CEO and the board chair. It should involve the full board, and it should be a formal process that's scheduled. We also believe as part of this process, it's important to request a CEO self-assessment. Self-assessment should include a CEO reflection on their own performance, as well as the board soliciting feedback from direct reports. Once the results are gathered, it's important to focus on the results. It's not just a check the box to get it done. It should be a process that allows you to evaluate the success of the CEO, identify challenges, set and realign goals, and then provide action for the future. This obviously is a time that lends itself to having compensation discussions. It varies between organizations as to whether there's a direct link to compensation from the appraisal process. Nevertheless, it's an important time and it lends itself to have those conversations. And finally, it's important to continue these communications as ongoing. It's not just a one conversation, but it should be continuing throughout the year in a less formal way. This process will provide an opportunity for all board members to offer their input. It includes a CEO self-assessment and comments on the work of the board itself. So often in those CEO assessments, when they're conducting it, their self-review, it provides feedback to the board where they may improve their relationship with the CEO and the work that they're doing. Finally, a CEO appraisal sets an example for all senior staff and other leaders in the organization that openness to feedback and improvement is important. I'd like to take a minute now and we'll switch to Jim's aspect of the presentation for planning, strategy, and alternatives to CEO compensation.
Okay. Okay. Hopefully everyone is seeing the additional presentation on the screen. I'm Jim Longacre. Thank you for including me in this presentation. Okay. So I think the discussion of the CEO assessment leads very easily into the discussion of CEO compensation. One of the tough things is just, how does this conversation happen? Especially in our industry, nonprofit industry, people aren't typically in this industry to make as much money as possible. How do you have this conversation? So, and it would be, in the new hire context, clearly you have to have it. But then ongoing is more the issue that we're going to talk about. You want to include in that conversation the CEO, board chair, your finance people will likely need to be involved. You may want outside legal counsel, and we'll talk about the role of a comp consultant. But it is something that you do need to have each year. We'll talk about some of the repercussions of letting things slide. So to the extent that you're following the practice discussed so far of having a regular CEO assessment, it just makes sense to have a specific time each year. At this board meeting, we will talk about the CEO comp. Just have that scheduled. Now, what are you trying to do with CEO comp? There's different outcomes. You may be looking to motivate. You may be worried about someone leaving and want to retain. You may be trying to attract someone and even attract other executives. Make it clear that your organization is a preferred organization to work for. Someone commented once that you may, instead of retaining, you may be wanting to send a message that, hey, it might be time to think about going somewhere else. So there's all these things that you're looking at and trying to design the compensation structure. As we'll discuss further, being a nonprofit, filing a Form 990, you need to be aware that this information will become public and be cognizant of that. Yeah, and people are watching what you do. We'll talk a bit about the IRS review of this, state regulators, donors to your organization may be looking at how much the executives are paid. Your residents are definitely very concerned as to what their fees are going to. In this industry, your customers are right there and very in tune with what's going on. Your competitors might be looking at it, if you're underpaying, looking at that as an opportunity to poach talent. Now, so that's some issues on the process and philosophy. What are the risks involved? Because it's a tax exempt organization, there are rules under the code and IRS that you can't pay executives too much. You can't use the organization to improperly enrich the interested parties. The worst case is revocation of tax exempt status. The IRS could come in and say this whole thing's a sham. We're going to take away the tax exempt status. But then there are what are called intermediate sanctions, because they're not as bad as taking away the exempt status, that are imposed for excessive compensation. The two issues, again, that the IRS focus on is that the earnings of the organization can't inure to the benefits of any individual. Example, recently, not trying to make a political statement, but the Donald Trump Foundation was found that wasn't used for an exempt purpose, and was used for other things. That was a big one in the news. And again, impermissible private benefit that the organization is being used for the benefit of an individual rather than its mission. But I mean, the more typical area where executive comp comes up is that the IRS can impose a penalty if they find that there's an excess or excessive benefit being provided to an individual. And this slide here goes into the specifics of there's a potential 25% tax. And if it's found after audit, it can be a 200% tax. And it's on both the amount and also on the organization managers that approve it. So the board potentially has liability here as well. So how do you avoid this issue? You need to have a process for setting compensation and document your process. How did you go about it? What did you look at? What factors did you consider? There is in the IRS regulations that if you follow their process, you can establish a rebuttable presumption of reasonableness. To establish this rebuttable presumption, the transaction, the payment to the executive must be approved in advance by disinterested members of the governing board. You must look at valid comparability data in approving the compensation, and you got to write it down. There need to be minutes of your board meeting saying this is what we looked at, this is what we considered, or our subcommittee did this. That there's documentation. One way to do this is to use data. You look at compensation studies, you look at what your peers are paying, see what's market for paying an executive. The sources for this, there's compensation surveys. Leading Age puts out a survey. There's other things you can look at. Form 990s of your peers. Those are publicly available. I'd say be careful about that. They're often a little dated. The information is often a year or two old, and some organizations may not be reporting correctly, so just use that carefully. And you can also hire a compensation consultant who knows the industry. Hopefully there aren't any compensation consultants on the line. This is up in my office. I do a lot of this executive comp stuff. This is comp consultant comes in, says he's totally objective, and the comp immediately says, CEO, you're brilliant. I recommend the company buy you a pony, a strong pony, to carry out the huge bags of cash I recommend for you. So that's sometimes a little criticism of comp consultants, but generally no, they do good work, they have good data, and they'll help you through the process and help you establish this peer group. Things to worry about in doing this process of trying to establish peers. You gotta look at the right size organizations. You can't be looking at an organization, your single site entity, looking at something that's a multi-site entity with 6 times the revenue that you do, and argue that the CEOs should be paid comparably. The regs do allow nonprofits to look at for-profits, but that should be done with caution. Certain jobs, it may make sense where your main competition is coming from the for-profits sector, but generally with the CEO, it's best to try and find a comparable nonprofit. Other concerns would be targeting too high. Our CEO is the very best ever, and everyone around us is paying less, but ours is so much better. You better be able to document it with skills, experience, background, have some reason other than that this is just an incredible person. Other thing to be a little bit careful about is the kind of idea where we want to give the CEO a going away present. You need to be able to show that that's reasonable, because you should be getting services. There should be something you're getting for the money you're paying. This here is another example of that you have a long-serving CEO and you've never, and really everyone says they've been underpaid for too long. At the end, we're going to ramp them way up. That's hard to justify. The thinking is that they agreed to work for that in the prior years. That was reasonable compensation for the prior years. And so you just need to be careful. Again, have some reason for it, document it, be able to show peers and comps. Okay, so now we've done all that. We kind of know the ballpark we're playing in as to what's appropriate compensation. Now, when you're structuring it, generally, in what I've seen is mostly salary, not a ton of bonus. Some organizations are going more toward a bonus structure. You want to be clear that you're not tying it to profits or net revenue, because you're not supposed to be incentivizing profits, but that's a possibility. Other items that you can use and that executives might find meaningful are reimbursements, training, various welfare benefits. Vacation can be very valuable to people, and that's designating and insisting on certain amounts of vacation can be a very, very valuable compensation component. We're seeing more employment agreements, I'd say, in the industry. Typically, a common reason for an employment agreement would be if you're asking someone to give up a good current job. They may be feeling like they're taking a risk and want to know that they have some security, that if things don't work out, if the board changes, suddenly they're on the out, that they have some type of severance. That may be a reason why both sides would see it would make sense for a employment agreement. When you're doing the employment agreement, things that are negotiated is how long it is, what's the severance term if they are fired without cause. When I'm representing executives, both here and in other industries, there's a lot of discussion on the cause definition. When can you fire me and just get me out the door? There should be something more than just we don't like you anymore, because we're not going to pay you severance if it's terminated for cause. But that's a negotiated item. Non-competes, depending where you are in the in what state, they may be enforceable, may not be enforceable. That varies significantly state by state. Other things that we can do, some more creative things with compensation. Oftentimes, the executive, again, if it's a longer service executive, may be interested in saving more for retirement, and what creative things can we do there? Code section 457 of the Internal Revenue Code talks about what you can do in the nonprofit context. You can add that on top of your 403B plan or 401k plan, whatever you otherwise have, to allow an executive or an executive group to save more. And that's often a valuable benefit. There's a limit. The IRS just came out, and I just updated this in the past week. It's now $19,500 for 2020 as to what can be set aside there. That's the max. There are other possibilities that you can do that called a 457F plan. To the extent you have someone that the board's thinking, hey, we want them to stick around. Let's give them something that they got to be here for 5 years to get. So they're incentivized to work that 5-year period. We can structure things that way. So there's other alternatives. Kind of fun of working this area is that each situation is unique, and we can try and structure something that is really a win-win for both the organization, the board, and the executive. So I'll just close with, as you're doing this, document, write it down, have committee minutes, have board minutes, talk about what you did, be very clear, and again, try and have this be a regular review. So that's running through my things. We talked about that we'd open it up for any questions at this point.
Thank you so much, Jim. This is a reminder to please go ahead and continue to submit your questions using the Q&A button on your screen. We'll go ahead and get started with one that came in from a participant asking Elisa if we haven't been doing annual assessments, how do we get started?
Sure. Thank you, Twyla. Yeah, I think the best way, if you've not been doing them in your history as an organization and with your board, the best thing is to have a conversation with your CEO that, you know, it is a best practice and viewed as a best practice and you'd like to begin, that you would want to work in establishing and make sure you have established goals with your CEO. So if you've not, that would be an opportune time to do so. And what those goals and expectations would be. You'd want to develop a process and then identify a tool to use. And then, as we talked about earlier, who will be in charge, what board member or committee of the board. And you'd want to communicate this process to the CEO as well as the full board, so that it's very transparent, that you're really just embarking on a best practice and there's not some other issue at hand that you're trying to address. And finally, I think with that, if you're going to be starting this process, it would be a good practice also for the board to do their own assessment at the time and just go full circle with evaluating the board and CEO.
Great, thank you. Jim, this question comes in for you. Can you talk about some examples of where things have gone wrong in designing compensation plans?
Yeah, well, I think I talked a little bit about, I referred to one before, is that where there's, it hasn't been paid attention to as you're going along, and everybody knows that the CEO is underpaid with the idea that there'll be some type of catch-up later, and then it becomes problematic both from a cash flow perspective for the organization, that they weren't expecting this amount, and also from the IRS point of view, if now with the catch-up you're paying the executive above market comp. So that's really an incentive, as we said, kind of to address this every year, be looking at peers, keep up to speed with it, and don't let it slide. So I mean, my message would go out to both board chairs and CEOs that stay on top of this and be ready to talk about it, and don't let it be pushed off to future years. Another kind of component of that is that, well, okay, we didn't pay the CEO that much, but now we're going to pay them something in retirement out of general assets. Now you're trying to bring a new CEO in, pay market comp there, and you still have the liability being paid to the person who's left. We've seen that. I've seen that in the law practice where we've been acquiring, where you're trying to acquire a organization and there's this liability sitting there to this departed executive. That's really a crimp on cash flow. So those are two ideas.
Thank you, Jim. And thank you, Elisa. Also, we would encourage you to continue to get in touch with either Jim or Elisa or MHS to continue engaging around these questions. Thank you for joining in from around the country. We do want to remind you that all MHS members get a CEO board assessment with their membership. And we also provide that service at a consulting fee as well. So please feel free to reach out to MHS if you're interested. We look forward to staying connected with you, and we plan to share news of our 2020 webinar series after the new year. Thank you so much for joining, and have a great day.